Hello everyone, my name is Cristina. I'm a PhD student of finance at Bucharest University of Economic Studies. As you can see on the screen, our topic today is investigating cash replacement as a means of fighting money laundering, the case of digital currency and its economic impact, a paper written with the help of my colleague GHEဍU, Raluca Andrea. My presentation into four main parts: an introduction, the motives, the instruments, and results behind the fight against money laundering, our proposal to fight money laundering by using CBDC and cryptocurrency, and I will end my presentation with some conclusions based on our findings. Money laundering is a phenomenon which has been recognized as a threat almost 33 years ago. Despite the measures taken over time, the number of suspicious activity reports has been rising. The number of money laundering offenses also has been rising, and cash is still the raw material of most criminal activity. Even in the case of electronic fraud, the criminals withdraw the stolen funds and transport it to another country, or maybe move it into another account to break an audit trail. And given these circumstances, we thought what we could fight money laundering by reducing the amount of cash in circulation, by replacing the cash with a digital currency, a centralized digital currency, and also a decentralized digital currency, as you will see in the next slide. Why fighting money laundering? There are several reasons why to fight against money laundering. Money laundering reduces tax revenue by facilitating the undeclared economy. It facilitates corruption and crime, which in turn slows down economic growth. It facilitates illicit migration of capital, so what we know as illicit financial flows. Reduces productivity, given the investments in sectors that do not generate added value for the economy. It gives an unfair competitive advantage to those operating illegally. Increases the risk of macroeconomic instability of exchange rates, monetary aggregates, and in terms of social effect, it transfers the economic power from the market, from the government and the citizens, to the criminals. Despite the increase in the use of alternative payment instruments, it looks like cash is still the king. Cash is still generally the form that illegal funds take in the preliminary stages of money laundering. It is still widely used in the criminal economy, and it remains the raw material of most criminal economic activities. Right? In Romania, it has been observed the maintenance of increased appetite for cash as a tool used in suspicious financial behavior, and during the pandemic, it has been observed a rise in the demand for euro banknotes. An increase of $190 billion between March 2020 and May 2021. The fight against money laundering has been taken to at different levels. At a legislative level, in Europe, the fight has started in 1991 with the first anti-money laundering directive, the birth of what we know today as customer due diligence, know your customer, and suspicious transactions reports. Cash became an official problem with the third anti-money laundering directive, when it was introduced reporting obligation of the payments made in cash above 15,000 euros to every natural legal person trading in goods, and in the same year it has been issued cash control regulation. For each person entering or exiting the European Union to declare has the obligation to declare cash above 10,000 euro. The fourth anti-money laundering directive decreased the threshold for reported obligation to 10,000 euros and extended this obligation to estate agents, persons trading or acting as intermediaries in the trade of works of art. At the global level, the threat posed by money laundering was recognized in July 1989 when the G7 group established the Financial Action Task Force, which in April 1990 issued a set of 40 recommendations, and in June 2003 published another 9 special recommendations. These legislative instruments lead, unfortunately, to unsatisfactory results. Because today, after 33 years, we have only 10% of the suspicious transaction reports further investigated. Barely 1% of criminal proceeds in the European Union are ultimately confiscated, and according to a study, the money laundering market is expected to grow with 15.60% over 2020-2027. The money laundering phenomenon is a wide-ranging phenomenon. As you can see in the figure between 2030 and 2018, countries such as Romania, Germany, and Russia recorded a decreasing number of money laundering, but while countries like Sweden, Switzerland, Hungary, and Austria faced more and more money laundering offenses, according to the United Nations Office on Drugs and Crimes. So we can say that money laundering is still a rising phenomenon, and we need to change how we fight against this phenomenon. That's why we propose a different approach to fighting money laundering. We know that law enforcement entities must deal with different challenges, legislative frameworks. Each state has its criminal justice system, civil procedures, and financial regulators. But we think that a good reason why fighting money laundering isn't working as we expect is that cash remains the raw material of most criminal activity. And we think that replacing the fiat currency with a digital currency can be an effective approach to fighting money laundering. That's why today we are discussing whether a virtual currency issued by the central bank to replace is a good instrument to replace cash to reduce money laundering, or cryptocurrency to replace cash as a means of reducing money laundering could also work. At this moment, 100 countries are exploring the possibility of adopting a virtual currency issued by the central bank. Some are researching, some testing, and a few are already distributing it to the public. Over 80% of the central banks are exploring the Cbdc for retail or wholesale reason. There are several opinions, several pros and cons against Cbdc. Central bank digital currency might offer more resilience, more safety, greater availability, and lower costs than private forms of digital money if designed prudently. If the cost of using a Cbdc is not too high, using a Cbdc can be more efficient in terms of allocation than using cash. If the introduction of the Cbdc follows a set of basic principles, bank financing it is not necessarily reduced, and the provision of credit and liquidity to the private sector do not need to contract. But there are also some, let's say, cautious approach to CBDC issuance, and we need to take into account that if central banks are less efficient than the private sector at resource allocation, overall economies losses can occur. And we also need to discuss and to take into consideration if a centralized approach would be preferred to a decentralized approach based on banks and other private actors. As previously shown, the political debate and the academic literature is focusing on the broader economic implications of the CBDC. But what about the impact of CBDC on crime? What could CBDC bring to the table? At this moment, we know too little about the concrete effects of CBDC on the money laundering offenses, given that they have recently been adopted as a legal tender in only 2 states in the world, Bahamas and Nigeria, and therefore we try to analyze these two CBDC from a money laundering point of view. The sand dollar is the digital version of the currency issued by the Central Bank of the Bahamas and is kept in a digital wallet. It has 2 levels of individual wallets available, one with a government identification requirement, the one with a holding limit of $8,000, and one with a holding limit of $500, which has no government identification requirement. The wallet can only be issued by certain authorized agents, and after the applicant has provided the necessary know your customer information, which is a great instrument for fighting money laundering. And also interesting aspect is that the central bank may require the authorized financial agent to take the necessary steps to make due diligence to register a wallet as belonging to a legal entity account if the profile of that portfolio holder has the potential of a commercial operator, hence with several identification requirements. In IRA, the first African CBDC launched in October 2021 also seems a good replacer for cash to reduce money laundering. It assures transparency, safety, security with traceability, and when used in IRA, transparency keeps everything tracked. Cryptocurrency is another digital currency that can be used to reduce money laundering. And despite the 2 main criticisms, we think that this environment, the blockchain behind the cryptocurrency can be used by the law enforcement successfully. But we will talk about this in the next slide. The first criticism is about the fact that the cryptocurrency can be used to launder money. So digital currency have proven to be ways to launder money, can be used in the criminal activity of money laundering. Some are saying that are great if you're trying to hide or launder money. But there are also opinions that think that cash is still the real threat, and cryptocurrencies are currently used in a tiny percentage of crime. And another criticism is about the volatility of this currency. So, giving the facts, we wanted to see the numbers so as to see if these opinions are sustained by numbers. Well, the numbers are not sustaining 100% the previous opinion, because according to a report launched by the Chainalysis, in 2021, the cybercriminals laundered 8.6 billion worth of cryptocurrency, which it is a 30% increase compared to 2020, but accounted for just 0.15% of all cryptocurrency transaction volume in 2021. So if we compare the $33 billion worth of cryptocurrency laundered since 2017 with the 800 billion to 2 trillion of fiat currency laundered each year, we might say that the cryptocurrency environment is still a safe place, and cryptocurrency is not that frightening in terms of money laundering. And about the volatility, a study showed that a weak relationship between future cryptocurrency returns and the realized volatility. And according to the Bitcoin Volatility Index, it seems that the magnitude of the price oscillations has significantly decreased over time, and cryptocurrency is gradually losing its volatility. So overall, we think that with the help of the good guy data analysts and virtual assets providers, the blockchain behind the technology behind the cryptocurrency could be an excellent instrument for law enforcement agencies in the fight against money laundering. And we think we need to be more open to this digital currency because we could use the same technology used by criminals to hide assets to help bring them to justice. So at this moment, both cryptocurrency and the CBDC could help reduce money laundering, in our opinion. Yes, the CBDC seems to be a more viable solution for fighting financial crime since the technology behind this type of virtual currency assures security and privacy. But the crypto environment is still a safe place from a crime point of view, since only 0.15% of all cryptocurrency transaction volume in 2021 was subject to money laundering. So replacing cash with cryptocurrency could reduce the crime rate, mainly by limiting the number of perpetrators due to the technical expertise required to use these platforms. However, is not a guarantee for a future with less money laundering, given the lack of transparency of transactions and the presence of anonymity. But we firmly believe that this problem could be easily solved by a partnership between law enforcement and the good guys behind the blockchain technology. Taking into consideration our paper and the findings of our paper, the next step in our research would be to deepen the advantages and disadvantages of using this to substitute cash, and to find the opinion of private actors regarding this subject through a survey. And this will help us analyze and present the entire picture before recommending alternative payment instruments as a means of fighting money laundering. So thank you very much for your attention. Looking forward to meeting you maybe in the next IBIMA conference.